So that's Organon, and this was a spinoff. I am familiar with this company. These guys focus on women's health, and Organon and Company develops and delivers health solutions through a portfolio of prescription therapies, medical devices within women's health in the United States. They were a spinoff. I don't remember if it was from Merck. They were a spinoff from one of the big giant companies. It was probably Merck or one of those larger ones. And their market cap's $4 billion, revenue is $6.41 billion. Forward P is super low, 4. Oh man. Dividend is super high at 7%. Wow, the stock's really sold off. Now, I led the live stream talking about healthcare, right? So this is kind of an example, but we'll see where the fundamentals are. I mean, this PE is just really, really, really low. And keep in mind, one thing that I like about Organon is spinoffs tend to work. These guys were part of a larger, very well-run, massive company. I believe it was Merck. So they're very well run. They've been professionally managed for a while. They've had to report their income and be accountable to the CEO, CFO of a large company. And now they're independent. So a lot of how the company has been operating is going to be kind of a discipline that they have internally. Revenue is growing by 4%. Last quarter grew by 4%. They had a flat quarter. And then the first quarter of their fiscal year was at 5%. Okay. It's not great growth, but I'm glad that it is green. All right. So free cash flow for the trailing 12 months, $747 million. Gross margins, 58%. It's very good. Okay. So let me look at the quarterly. So free cash flow in the quarterly looks like the last quarter was about 100 million. Q2 was good at 300 million. But it's been a little bit of up and down, but trailing 12 months, I think, is reasonable at 747 million. Okay. Looks like it could go up from there. Okay. All right. Let's take a look at the balance sheet. Now, if they were spun off, the company could have been spun off with a lot of debt. 8.75 billion in debt. Cash is only 763. So we're up to about 8 billion in debt. Their EBITDA is 1.76. So the balance sheet I do not like. It's more than 4 times EBITDA, and that's a little high. Debt to EBITDA 4.78. So that's a red flag. The company is kind of growing, which is good. That balance sheet's bad. And if we look at the interest expense, you see it's pretty substantial. And we're seeing that interest rates are going to stay higher for longer. So that expense item is going to stay at that level or may even go up a little higher because they may be carrying debt that was financed, 5 years ago at a really low rate, and they have to refresh that debt. They have to pay much more. So debt is not good. Debt shows that a company is not good enough, healthy enough to just load up the balance sheet with cash, pay off debts if they want to. In this case here, they're kind of behind the 8 ball a little bit with that debt. So I wouldn't touch the stock because of that debt level. I'd want them to operate maybe a couple more years independent. And then we could, because they were spun off, I guess, in the 2021, middle of 2021. And so they've been operating as a standalone company for 3.5 years. So I would want them to operate a little bit more. Give me some more data. Show me that you're going to pay off that debt. And I'll just check the debt level to see if it has a trend where it's going down. I don't want to see it going up. So it is going down. So looks like they were spun off. They were spun off with a pretty sizable debt level, but they have been paying it off. That's good. They just got to keep paying it off, get that number to a reasonable amount. They're not growing really fast either. So it's not like, oh, they're going to grow and double their revenue. No, they're growing at like 3, 4, 5%. So it's going to take a while for these guys to get big and really grow their metrics. So this one's a pass for me just because of that balance sheet. I think it's risky. And I think it's enticing, instead of paying this dividend, I know some investors would be mad. Stop paying the dividend, pay down your debt, because what can make investors really angry is if you go bankrupt. In the 5 years, or I guess 3.5 years, it's down 50%. In the 1 year, it's down 6.51%. So if you compare the the stock depreciation, it's gone down compared to the dividend, you're only ahead like less than 1%. So I don't think any investor would be happy with that. So that's Organon.